And welcome to CNBC's U.S. Markets Edition. I am Brian Sullivan in the United States. Thanks for joining us wherever in the world you might be. Here's how our markets and maybe your money ended our day here in the States. The S&P and the Dow both down just a little bit, but the NASDAQ up just a little bit, a little more than a little bit. The NASDAQ is up 0.7%. The Dow fell 0.2%. So when I say up and down, not a huge move here. But hey, the NASDAQ continues this rally that we've been on. This week, the S&P 500, the Dow, up about 4.1%. But the NASDAQ has soared more than 6% just this week. Now, and part of that is because chip stocks leading for a second day in a row. NVIDIA kind of still riding high on its Saudi deal news. AMD getting a second benefit of an announcement from a $6 billion stock buyback as well. A lot of news around semis. The Saudi forum yesterday as well. Semiconductor stocks higher today. AMD up 4.5%. NVIDIA up another 4%. Big moves, big money markets, big guess. So let's jump into some of the biggest interviews and conversations happening across CNBC here in the United States. And you just saw how well our markets have done lately, but we are barely higher on the year, and many other nations have made investors more money than America this year. Don't believe it? Well, let's take a look at a few. The U.S. ETF that tracks Germany, it's up 28% this year. Mexico's ETF, up 26%. And Brazil, which I wrote about just over a year ago and has been doing terribly, to be perfectly honest, is finally showing some signs of life. It's up 26% so far in 2025. Some smaller markets, by the way, around the world are up even more. And we spoke with a famed money manager who's probably been to every one of those markets and those nations. He has logged millions of miles on airplanes and is considered a trailblazer in investing in emerging markets. Here is Mark Mobius of the Mobius Emerging Opportunities Fund with where in the world he sees the most bang for your buck.
I think the main reason is because Trump has opened up the whole world in the sense that people are now realizing that anything is possible with Trump. And as a result of his trade negotiations with China, now China is not the only game in town. We're now seeing all these other countries entering the export market and being able to compete. So it's really very exciting to see what's happening around the world. And probably the most exciting place now is India, because India is going to be taking the place of China in many, many areas. And we've already seen companies like Apple and others come to India to manufacture and export. So India, Vietnam, Taiwan, Turkey, those are the ones that are looking very interesting for us at this stage. But as you pointed out, there are many other markets around the world that are doing better than the U.S.
So, I mean, although the U.S. has come back, so maybe it's taken a little bit of the wind out of the sails of this Sell America idea, Mark. What did you think about that at the time, and what do you think about that as a risk going forward?
Well, you know, one of the things we've discovered, and one of the reasons why our new fund encompasses not only emerging markets, but the U.S. market, because many of the U.S. companies are actually emerging market companies. Let's take Apple, for example. Where do they manufacture all their products? Where do they sell all their products? Emerging markets are a big part of this company. So that's the kind of thing we're looking at. We're not only looking at the emerging markets, but at companies in America that are benefiting from the growth in emerging markets.
Would there be any other examples of that?
Another good example would be Microsoft. Microsoft is exporting its software around the globe. And that would be another good example of a company that is really a global company, not a U.S. company.
The richest man, the richest man in India is going to be meeting with Donald Trump in, I think, Doha, Qatar in a few days. There's a lot going on there. I used to trade commodities in a life a long time ago, and you know, the one thing I liked about India was that it was rule of law. They used British law, and you could actually enforce a contract. In China, it was tough. Sometimes the people would just vanish. You'd sue them, and they would just disappear. But India has a lot of problems, Mark. I mean, they don't have a lot of electricity. The infrastructure for supply chains we want to believe it's there, but it's not. It is now the most populous nation in the world. How risky, though, is India as a lot of opportunity, but I would imagine a lot of risk, too?
Well, the big problem with India is bureaucracy. As you know, they inherited this incredible bureaucracy from the British, and the party that took over, the Congress party took over, perpetuated that bureaucracy. But Modi, the new prime minister, has done a tremendous job in cutting through a lot of the bureaucracy, but still there's a lot to be done. And he's digitizing the entire economy. First of all, by getting digitized identity cards for everybody, so money can be transferred directly to bank accounts, even to the poorest people in the country. But this takes time. I call it the United States of India because you have all these states, many of them with different languages, both written and spoken languages. So to unify this country is quite a job, but still the opportunities are there because you have a lot of very smart people. And as you say, it's the most populous country in the world now. We figure about 1.2 billion people compared to, I would say, now India's bigger than China. China maybe 800 to 900 million.
Wow. It's a huge difference and potentially a very bullish development in many ways. Where are you less enthusiastic, Mark? As a lot of investors are doing their homework on international stocks as they see some of this outperformance. Where would you kind of, steer them clear of?
Probably Latin America, with the exception of Brazil and Mexico, maybe. But Latin America has got a long way to go to reform and to change. Of course, a prime example of reform is Argentina. That's done very, very well as a result of reforms, but the market has outpaced all these reforms, and it's maybe a little bit too late to get in there at this stage, but it's worth looking at.
Yeah, I mean, what's the sort of the kind of the twisted joke? And I was bullish on, not that it matters what I think, bullish on Brazil. They say that Brazil's the country of the future, always has been, always will be, because they have their issues. They can't get out of their own way, but they do have a lot of power. Right? Petrobras. Does that change how you view Brazil? The fact that they've now discovered all these energy riches. Petrobras is sitting on some of the biggest and wealthiest oil reserves in the world. If they could kind of just get out of their own way, they might be able to monetize that.
Well, as you know, Petrobras is an incredible company, but you also must know that there was a big scandal surrounding Petrobras. And the reason why there was a change in government as a result of the corruption in Petrobras. Now, hopefully that's over, but that's absolutely right. Brazil has all these oil reserves, but more importantly, Brazil has agricultural resources, which is tremendous. And of course, Brazil has digitized a lot of the economy. We've been looking at central bank digital currencies, and Brazil is way ahead in that regard. So there's a lot of interesting things, but I must emphasize that we can't take this country as a whole. In other words, we've got to look at individual companies, and we are finding some good bargains in Brazil on an individual company basis.
Just a parting question, Mark. Do you have a position on gold, on any of the kind of cryptos, on any of these almost kind of global currencies amid all of these currency cross currents that could be quite significant this year?
Well, gold is a favorite of mine. I believe everybody should have some gold, maybe 10% of the portfolio, regardless of where the price is at any point in time. It's good at dollar cost average into gold. As regards to crypto, it looks like the U.S. is bound to become a leader in crypto, and that is going to be very important going forward. I personally am not a big fan of crypto, but members of my team are convincing me that we've got to do more in crypto. So we're looking at it more carefully. I'm particularly interested in the crypto exchanges rather than the coin itself.
Yeah. Quickly, do you still love Mercado Libre, one of the top holdings in your fund, MELI on the NASDAQ?
Yes, it's an incredible company, very well done. There's a good example of a Brazilian company that's doing quite well. Of course, it started in Argentina, but now it's big in Brazil.
And Mercado Libre, the stock, MELI, trades here. It's been red hot. That, of course, veteran emerging markets investor, Mark Mobius. Well, both NVIDIA and AMD unveiled major new AI deals at the Saudi-U.S. Investment Forum this week, with AMD also announcing a new $6 billion stock buyback. Bank of America senior semiconductor analyst Vivek Arya just raised his target on both of those stocks. And here's what he had to say about the implications of the latest Saudi deals and if they are enough to offset what they are losing from China.
So we think semiconductor companies, especially AI semis, are at an inflection point. That is NVIDIA, that is AMD, that is Broadcom, that is Marvell. Because if we rewind back a few weeks, look at the conditions that we had. We had U.S.-China trade tensions. We had restrictions on the shipment of AI chips. We had questions about cloud capex this year with all the news about lease cancellations. And I think these stocks were somewhat overpositioned. Now, if you look at where we are now, there's been a cool down in trade tensions. The AI diffusion rules have been rescinded for the most part. The positioning among these stocks has become a lot more favorable, and cloud capex has been on fire, right? People thought cloud capex could grow 8% this year. It's about to grow over 40% this year. And then, as you mentioned, there has been this increasing boom in these sovereign projects. And I think the reason for that is every country, every region, every nation state realizes that investing in generative AI, where you have large language models that are able to be trained on that country's local culture, local customs, I think is extremely critical, right? And being self-sufficient is extremely critical. And it's the same companies that they have to depend on. So we are really bullish. We think that this is just the start of the trend, just a few $1 billion per year when it comes to one of these countries. But this could be close to a $50 billion annual market over time.
I mean, Vivek, it is interesting, too, that this is happening in a region that is so energy rich. And we talk so much about how much energy it does take to run some of these types of AI models. I mean, what could be the implications potentially even broader, not just for these companies, but the field, if they're able to run these models on energy that is in no shortage?
Yeah, absolutely. I think you rightly pointed out that there is a direct correlation between energy and the performance in terms of computing power. In fact, a lot of these AI chips are being measured in terms of performance per watt. So that's become a key performance indicator for these the projects that these chip companies are coming out with. And the location of these projects, I think, will absolutely coincide with places where new power projects are going to go on. So we are starting to see that happen in the U.S. There is a move towards opening up even older nuclear power plants. That's how important the installation of these projects is. Then, as you mentioned, we are seeing these power projects come up in the Middle East. They are coming up in India. They are coming up in Malaysia. So absolutely, I think in order to forecast where AI will be deployed, one basically has to forecast where a lot of these power projects will open up. That's how close power and AI chips are correlated.
Vivek, I wonder whether or not you consider, as some do, AMD's quarter as one of the great surprises of the spring. We got the buyback today. We had Lisa Su on last week. A few things going right. How much of it is their own execution, and how much maybe is it Intel acting as a share donor?
Yeah, Carl, I think that's a fair point. Last year we were a little more cautious on AMD, but with this last earnings call, we did upgrade the stock. Because I think what's happening is that they continue to gain share against Intel in the PC and server market, that even though that market is not really growing, Intel just continues to misexecute and lose market share, and AMD is a great beneficiary of that. I mean, it's shocking that in the past, AMD's average selling price used to be 50-60% below Intel. And in many cases, now their average selling price of their products is at or above what Intel is able to claim. So that's the quality of their products on the CPU side. Then on the GPU side, I don't think it's as much a share gain story for AMD. I think it's more a case that they are one of the key players in this market that is just growing very rapidly. So if AMD can put together this combination of continued share gains with Intel, just being very successful in the AI market, their embedded business is starting to come back. Game consoles are coming back. You have a company that can grow top line 20%, earnings mid-20s, and it's trading below market multiple. But as you mentioned, very solid management team with consistent execution. And this morning they announced a big stock buyback, which I think is a great sign of their confidence. So
between the two biggies, the NVIDIA and AMD, is the opportunity any greater on one than the other?
Yeah, when in doubt, I think we always prefer companies that are a lot more profitable. So NVIDIA and Broadcom have consistently been our top two favorites. But I do think, with AMD, it's a name that has been forgotten to some extent, right? It's a name that's been put aside. And every time we see headlines like we saw yesterday where AMD is essentially on the similar footing as NVIDIA is in terms of going after these projects. I think it just reminds people that this is also a very important company in a very attractive market of computing infrastructure, and the valuation is extremely reasonable here.
Well, that was Bank of America senior semiconductor analyst on the AI opportunity within AMD and NVIDIA. Oh, NVIDIA, by the way, leading the Dow on our Wednesday. In fact, not only did NVIDIA rise 4%, but NVIDIA with that gain is now back in positive territory for the year and back above $3 trillion in market cap. It's also closing in on Microsoft to once again become the most valuable company in the world. There we go. All right, we've got a long way to go as you start or maybe end your day. And up next, you're going to meet the head of one of the largest shipping companies in the world. And if you thought he might have an opinion about U.S. trade talks, well, you're exactly right. And as we head to break, take a look at Palantir hitting a new all-time high and now back on top of the leaderboard as the best performing stock in the S&P 500 this year, up 72%. We're back after this. And welcome back to U.S. Markets Edition. Well, the murky trade waters have cleared up a little bit in recent days, but let's also be clear. It's been a crazy and hectic last few weeks for global trade. As we showed you on Thursday from the Port of Long Beach, California, ship traffic has already fallen into the United States, most of that coming from China, where you may be watching right now. So how does one of the world's biggest shipping companies handle this kind of turmoil? Well, we want to find out. So Maersk, North America President Charles van der Steen came on CNBC. Talk about how his company, the shipping giant, was nimble enough to avoid disruptions.
The last few weeks since Liberation Day have been volatile, to put it mildly, across the entire industry and across our entire portfolio. So tariffs were introduced, tariffs were changed, tariffs were postponed, and in some cases within just a few days of distance. So we've been working very closely with our customers in that same period to find solutions for their respective supply chains, to make sure that we either pause, because most of our customers will pause their supply chain out of China, or redirect to different destinations away from the tariffs that they would be implied with.
So what did that mean for the ships you had on the oceans at that point? Were there stoppages? Were there speeds ahead of Inauguration Day or ahead of April 2nd to try and get things moved through? Like what did it look like on the ground?
If you look at the immediate impact of the Liberation Day tariffs and the weeks afterwards, it's been an impact specifically on the China to U.S. trade.
Which affects how many ships for you?
It's 5% really only of our global network. So we've seen a reduction of approximately 30 to 40% of the flows into the U.S. So 30 to 40% lower volumes in the course of both April and May. But if you take a step back, you'll realize that that's only 5% of our global network.
Okay.
And if you look at the global network, which of course covers also other trades in and out of the US, including global trades, normal growth has actually continued. Trade has continued. And in some of the trades, you've seen some substitution. So the growth has actually been more robust. So while the impact is big...
It was shifting things around, but it didn't have a huge impact on your bottom line.
No, at this stage, it's not contaminating any of the other trades.
So how did you deal with that, though? I would imagine that ships had to be put on entirely different paths, entirely different transit paths for all of these.
What you would have seen in the industry, it's that approximately 25% of capacity has been taken out of the industry, specifically, again, on the China to U.S. trade. Mm-hmm. Now, that comes in different flavors. One would be to simply take vessels out, to take ships out, which would then be redirected to other trades. In our case, we've been able, because of the new network that we've deployed, to not necessarily take ships out, but to swap them simply from a bigger ship to a smaller ship and reduce our capacity as a result. And right now, when we look at the current reprieve, the exact same thing will happen, but in reverse. So we're ready to now swap smaller vessels back to bigger vessels and reintroduce capacity on the trade out of China.
What is the new system that you put, the new network that you put in place, a new technological system that helps you do that?
It's not so much a technological system. It's a modular network that allows us across our 700 vessels across the globe to make sure that whenever disruption occurs, we're able to isolate it in a single location and be much more nimble to then react to that disruption and allow both for our service to remain consistent, in this case, to continue ships every single day from Asia into the US, but simply take smaller vessels and as a result reduce capacity without impacting services.
Smaller capacity because there's just less trade that's going back and forth across?
That 30 to 40%, of course, requires a smaller capacity to serve it.
Is that something that your competitors are doing as well, or is that an advantage over them?
It's a big advantage, I would say. Competitors mostly, or our peers in the market mostly, have taken ships out, blank sailings, as we would call them in our industry, which really roughly means that this week there will be no sailing, but there will be a sailing next week. So the consistency of service gets impacted. The effect is the same. Capacity is taken out of the actual trade.
I would assume the longer that capacity is taken out, the more difficult it becomes, the longer it takes to get it back up and running when there's a restart, just finding the crews, putting them back together?
It's actually not that complicated, but I would argue the main challenge today, as we speak, as the details of the reprieve become more clear, that over the next 90 days, there's clearly going to be pent-up supply that sits in China that needs to be reintroduced to the supply chain and get towards the market here in the US. So to bring capacity back in for vessels that have been redeployed elsewhere will be more difficult. In most cases, those vessels will be waiting for the reprieve and actually are, within a few days, available again to ship.
I mean, it's kind of amazing if you're looking at your one-year chart. You're still up 14% over the last year. There was that huge drop-off on April 2nd as everyone reacted to the tariffs that were put in place. How do you prepare for any and all of this? Are you still making the same sort of CapEx investments that you would be making in new ships that come years down the road? Does any of that change?
I would say nothing at this stage changes. I think the uncertainty that sits in the market is one that is time-bound. There's an expectation that, of course, within weeks, there will be more clarity. There will be more clarity on both, will the 90-day lead to a permanent deal, not just with China, but with other partners, which means that the uncertainty that today stifles the entire industry, including ourselves, for the bigger long-term decisions will be gone. And as a result, your long-term CapEx decisions will also be reintroduced in the same way as they were before.
Now, to say Maersk is massive, it's an understatement. The company operates 700 ships around the world. You see their names everywhere, from Singapore to Shanghai to maybe even San Francisco. All right, staying with logistics, improving trade relations between the U.S. and China could have a big impact on America's ports. Some shipping analysts expect retailers to take advantage of the temporarily lower tariffs, right now at least, on Chinese imports during that 90-day pause to try to front-load all their imports. But the head of North America's busiest port, at least overall, the Port of Los Angeles, California, is pouring some cold water on those reports. He joined CNBC Wednesday morning with his expectations for the next chapter of trade.
Last week, we saw a drop of about more than 30% of the cargo that we were expecting coming in. For the month of May, we'll be down about 25%. No real indication yet about how big a surge may be, but this 90-day pause is not a lot of runway in our business, and the average of averages is still a 30% tariff.
Right, and I want to talk about that. Just put the down 25 or whatever the number may be for May in perspective. I know COVID, for example, we can all think about 5 years ago, but how does that rank in terms of a decline of that magnitude?
Second place. During COVID, March of 2020, we were down 50% at the Port of Los Angeles, and now we're looking 25% for this month of May. 17 of 80 scheduled ships were canceled for this month.
All right, so now we're dealing with 30%, at least for the next 90 days. It may go lower than that, but there's also a possibility it will either stay or go higher. What are your expectations in terms of increased imports?
Yeah, what I see right now, David, is that for about 4 consecutive weeks, we'll be pretty light on inbound cargo. Outbound as well. The ag sector hit specifically and really hard. Those 10% tariffs are cumulative based on other increases before. After that, we're going to start to see maybe some ship services reintroduced. For the month of June right now, there are still 11 of 80 services that have been canceled.
So on the empty shelves narrative, I know this is a few steps removed from the ports, but is there danger of that still, given the interruption in April?
Yeah, depending on how retailers and others buy, you may see spot shortages. We're right now at a tipping point because you got summer fashion, back to school, and May, Carl, is usually when the majority of the purchase orders go in for Christmas and the year-end holidays. So we're cutting it close in a lot of areas here.
Right. How long would you expect orders to get resumed until the 90-day deadline started to get filtered in back into people's minds?
Yeah, we're watching that right now.
Yeah.
Having worked in Asia for a long time, I still maintain a lot of contacts on the phone every evening trying to see how bookings or reservations are picking up, what services may be reintroduced. There's some pent-up demand, obviously. There's some products that were finished before this 145 went into place. So let's see how quickly we could load those up or get those containers to the ports and onto ships coming our way. No immediate jolt to the system just yet, but the next couple days should tell a story.
Meantime, rates are a straight shot up?
They may go up, but please remember that in the Trans-Pacific trade, about 90 to 95% of all that business is contracted annually. The spot rate is on a small amount of cargo, but is one of the indicators that we watch.
What percentage of the cargo that you're taking in does come from China, or I don't know if that's possible, and or the other countries, obviously, because we're still talking about South Korea and Japan and Vietnam and so many others of our trading partners that also have tariffs right now.
Right, David, 45% of our business portfolio is with China, both on the import and export side. That was 60% back in 2018, before the first 232 and 301 tariffs went in. So we've absolutely seen a migration of sourcing to Southeast Asian nations, but China still maintains a wide margin in that number one pole position versus the second player, Japan.
Do you think the longshoremen were an instrumental voice in sort of incentivizing this reversal?
I do. And our International Longshore and Warehouse Union put out a message a couple of weeks ago, which was groundbreaking for them. To be that strong on the subject of tariffs, let's get some attention. I also credit the media for amplifying our voice and saying, look, again, policy is policy. We're not talking politics here. But what we see on the ground, if you're going to drop by 30%, that impacts the dock workers, the truckers, the warehouse folks. It's the small to middle-sized importers that I'm most concerned with now. If they have to purchase at elevated prices, they can't necessarily pass that cost on to the consumers. They're competing with the big guys. So your neighborhood drugstore, pharmacy, home improvement store, they're the ones that we're watching right now. 125,000 companies call LA home on the import side of the business.
Is there a level of tariffs wherever it settles out that you feel is absorbable by that sector?
Good question, Mike. And what I hear from importers right now is they're going to negotiate a little bit with their manufacturers, see what they can do based on terms of sale, landed price. They'll try to find efficiencies in their own companies, a little bit of a margin squeeze, but let's do things a little bit better inside, and then let's see what we can pass on either to the consumer or, if you're a parts supplier, to the factory.
Are the other West Coast ports having a similarly bad May?
Yeah, all across the board. Some hit more hard than others. Last week, David, we had 16 ships come in. 11 had port calls in China, but another 4 specifically dedicated to China were canceled. We'll have a similar look again this week. So we're still moving cargo, just not at the levels that we should be this time of year.
Is it true that there were some diversions from Seattle to Vancouver, in other words? Goods that were...
Haven't seen that, really. That's been a debate for some time because you get the harbor maintenance tax in the U.S. It's a difference of about $300 a container if you bring cargo into Vancouver or Prince Rupert. So that may have a little different take when it comes to the terms of sale and the overall landing cost.
That was Gene Soroka. He's the head of overall, on an annual basis, the busiest port in North America. The Port of Long Beach, though, where we were just a couple of days ago, is actually the busiest port the last couple of months. So LA and Long Beach, physically connected, kind of duke it out every year. All right, nearly half of the Port of LA's business is with China, so maybe not a lot of people are in a better position to track some of that shipping data, along with Mario Cordero, who we interviewed on my show, Power Lunch, last week. All right, coming up next, big tech is back in a big way. A massive run for big tech, with NVIDIA helping to lead the resurgence, up 16% this week. But you may be asking, is it too late now to buy the stock? We'll talk about it coming up. All right, welcome back. Hope you're having a great start to your day. Top tech analyst Gene Munster came on CNBC to talk about tech's massive rebound the last few weeks. But Munster wasn't all in. This is why he's being much more selective right now.
You can't just buy the Mag 7. You have to buy pockets of it. I think about some of that performance. What's going on with Google is really breathtaking, what is undergoing in terms of the shift from 10 blue links. You cannot sleep well at night just simply owning Google. And I think that when you answer the question more holistically, there's still, if you look at, we looked at 20 different companies, tech companies in their reporting season and graded each of them. And of the 6 Mag 7, 5 of the 6, we gave it an A grade. And so there's still this outperformance that you're seeing with the fundamentals on these companies. But that doesn't mean that the best opportunities to invest is necessarily with them. And so, again, more of a targeted approach. I think that companies like NVIDIA, nice to see it return into the positive. But this company, if I'm right, where AI goes over the next 1, 2, 5, 10 years, this company is still cheap and will still have strength. So, John, you have to be strategic in terms of what you're buying. If you wanted to buy a basket, I would buy a basket of smaller tech companies, sub $500 billion, and focus on those. That's probably where your bigger outperformance is.
Yeah, a lot to choose from under $500 billion. I've been looking recently at names like Atlassian, which is at half of its 2021 highs. Zoom at $25 billion market cap is at a fifth of where it peaked out. And then there's DevOps names like MongoDB, PagerDuty, Snowflake. The charts don't look like people believe in them, but how much of a case is there to be made that some of these names are going to be decent AI beneficiaries?
Well, there's a great case, and I think that that's the fundamental question all investors need to ask, is just how transformative is AI going to be? And these companies, many of those that you just mentioned, are going to have a meaningful benefit to that. There's a lot of conversations around it, but where the rubber hits the road, that central question to ask is, how far along are we? And I think the answer is, one way to look at that is to look at GPT in terms of the percentage of the online daily activity that uses GPT daily. And it's probably coming up around 20% of Google's population uses that daily. The point is that it's still relatively small, John. And I think that when we think about this other class of companies beyond the big tech and think about the opportunity, if we answer that question about how far are we in AI, and the answer is we're still early, as defined by the amount of usages today, then you have, I think, a clear path where these companies will continue to grow higher for longer. And so we're at the point at Deepwater. I mean, this is, even despite everything that's happened over the past 2 years, we still believe we're early within AI and still are at the bet the firm in terms of our investment philosophy around how big the shift is going to be.
Now, Munster wasn't done. He went on to comment about Cisco Systems results, which are out tonight after the bell, reporting guidance ahead of expectations. And Munster noted that even AI support growth and some of the older line tech bodes well for the larger AI trade. All right, up next, a CNBC 1-2 punch, one of Wall Street's most famous short sellers and one of Wall Street's most storied stock pickers. Investment insight, straight from the pros. Stay tuned. Hey, welcome back, or welcome. Maybe you're just waking up. Thanks for joining us here on CNBC's U.S. Markets Edition. I can't see you, but I would say it's nice to see you. Here's a look at how stocks ended Wednesday here on Wall Street. They ended pretty well. Yes, the Dow was down 0.2%. I get it. But again, inside the market, the Dow maybe not the best representation. The S&P up very fractionally, but it was up. The NASDAQ, once again, big tech, your big winner, up 0.6%. And like we talked about yesterday with these moves, the S&P 500 and the NASDAQ 100, they are back in the green for the year. Been quite the run. I mean, I only half joke that the month of April, the tariff announcement here, markets collapse. People, let's be clear, some people seem to be panicking. And then the market rebound straight back up. It feels like April was 72 days long. Quite the rebound for the markets, now back positive on the year. All right, we had some great conversations on Wednesday at the Ira Sohn Investment Conference in New York. That is not only a big event that raises money for pediatric cancer, but it's one where a lot of the top minds on Wall Street and investors from around the world will get up and present their ideas. We spoke with Chanos & Company president and founder Jim Chanos, who told us why, after all these years, he is still short. In other words, betting it will fall against Tesla. We also sat down with Greenlight Capital president and founder David Einhorn, very famous hedge fund manager, who gave us his thoughts on Trump's trade war.
We have a big portfolio, so we have a lot of stocks we're short.
I know, but this is one that you've been identified with for
10 years.
As long as I can remember.
Yeah, at least 10 years. So, look, I mean, it's a wonderful example of what we just talked about a little earlier, which is a company whose earnings are declining, its revenues are declining, its valuation is increasing because investors are pointing to robo-taxis, autonomous robots, and then I joked this morning, asteroid mining by robots. I mean, the stories that keep building onto this company as people put hopes and dreams on back of one company and one entrepreneur, quite frankly, are just, sort of getting excessive. And we can definitely see the profits are dropping, unit sales are dropping, margins are coming down, and yet people think that robo-taxis will be amazingly profitable and that we're all going to have a robot in our backyard doing lawn work or whatever. The reality is we might, but it might very much look like the car business itself today. Lots of vendors, commodity business, buy a robot for $30,000 and the manufacturer will make $3,000 on it.
He does have a pretty good head start, though, on much of the competition. I know that, Uber has its own aspirations, and obviously Waymo is what it is at this point. But he has a much greater head start, does he not?
Yeah, but I don't think running in effect a taxi service is the lucrative business the bulls think it is. I mean, people are talking about $2 a mile, and his cost will be very, very low. The fact of the matter is actually owning the asset, which Uber and Lyft don't do, right? That's on the driver. Paying commercial insurance and all of the other costs, cleaning, whatever, downtime, your costs get north of $1 pretty quickly per mile. And with more supply coming in and costs relatively high, it's not an amazingly lucrative business. The entire ride-hailing business in the U.S., we estimate is a $50 to $75 billion business, which is dominated by Uber and Lyft and then private cabs like we have in New York. It's not a huge business. And it will expand, of course, but on the other hand, margins will come in. And right now with Tesla at, 180 times earnings, you're beginning to price in a lot of that.
What do you make of the expanded role that he took on in the government, and now the fact that he's going back? Whether he heard the calls for him to go back and, to his day job or not, the fact of the matter is, since he announced that he was going back, the stock has performed a lot better, and the analyst community and investors seem to be feeling a little bit better about not only what he's done, but what he's going to do now.
Right. But at the same time, that analyst community has been cutting earnings estimates, including, by the way, may I add, not just 25 and 26, but 28 and 29, the out years, where we're supposed to have robo-taxis, autonomous. The numbers have come in dramatically in the last year and a half. So for all of the hype and all of the excitement that retail has about the stock, the fact of the matter is the people with sharp pencils keep cutting numbers. And that's generally, but not always, a good sign for the bears, not the bulls.
The trade deficit, I've never understood why it's even that big of a problem in the first place. The idea that if some country is selling us goods and we're getting the goods, that we're somehow being cheated for paying for those goods, I don't understand that dynamic. I mean, I go to Chipotle and I buy a burrito. They get my money. I get the burrito. I don't claim that I was cheated because I spent more money on them than they spent money on me. I don't understand what this problem is that we're even trying to address.
So when Peter Navarro, for example, says of the trade deficit, it's the sum of all cheating, you just reject that out of hand.
Maybe he can explain it better, but I don't understand it.
In terms of the tariffs, you said in an interview about a month ago that they're a, quote, regressive tax. What do you make of the pivot from the administration and where you think all of this is heading now?
Well, I also said in there it seemed like it was the U.S. that's going to fold, and I think that that's what's happening. I think building a retreat. I think, they'll announce a lot of things that they claim to be victories, and maybe there'll be a victory or two somewhere in there. We'll just have to kind of see what that does. But if I were negotiating against the United States, I don't think I would have to concede very much, because they've already said that those crazy tariffs that they threatened to put on, if they actually followed through with them, would hurt the United States more than it would hurt anybody else. And that's why they had to pull them back and give themselves 90 days to, quote, negotiate. So I don't expect much to come of this, and I'm pretty sure in a few months we'll be mostly talking about other things.
You're a pretty astute poker player. You're saying that their hands have been potentially weaker than maybe they thought going in?
Look, Scott Bessent ran around saying that China has a pair of twos. Well, that's very interesting, because in poker, a pair of twos is not a bad hand. It's actually an average hand. And, if you're playing poker, calling out your opponent's hand is not usually a great strategy.
That was Chanos and Company President Jim Chanos and Greenlight Capital President and founder David Einhorn, who, by the way, is also a very good poker player, as Scott mentioned, at the Ira Sohn Conference in New York. CNBC is a proud longtime partner of the event, which raises money for childhood cancers. All right, a crypto play is up 49% in a month. The CEO was on CNBC. The name of the company is to be revealed after this. All right, we're going to reveal it. Coinbase was the mystery chart that we showed you right before the break. You probably knew that. Shares up big this week after news the company is joining the S&P 500. But the outlook for crypto coin regulation in Washington is still pretty murky. Emily Wilkins caught up with Coinbase CEO Brian Armstrong on Capitol Hill to talk about his outlook for the stablecoin bill.
I saw the actions last week as really just the first round of negotiation. I'm meeting with everybody on both sides of the aisle today, and the Senate has a lot of urgency to get this done. There's 52 million Americans who own crypto. They showed up in a big way in this last election, and what they really want from their representatives in the Senate right now is to pass sensible legislation for stablecoins. That needs to happen this week, and I think there's a lot of bipartisan support to do it. Now, the details really matter here, and we need to make sure we get this legislation right for America so we can continue to have innovation. That means crypto should be treated on a level playing field with banks and others so we continue to have financial innovation. It means that things like DeFi should not be brought into the AML rules. That would be a dramatic expansion of AML laws into a surveillance state. We don't want that for things that aren't trusted intermediaries. That's where the AML laws should be applied. So the details matter, but I think there's a lot of interest to get this legislation passed this week, and we're very supportive of that.
So are these just changes in the bill that are needed to get support, or is another piece of this Democrats saying that they can't pass any crypto legislation while the Trump and his family are personally benefiting from their crypto investments?
Yeah, so there's a lot of details in the language being negotiated at the last minute, just like any good negotiation. There's lots of concerns I've heard about, Trump family and that, but whether you love crypto or hate crypto, you need to get legislation passed. It really shouldn't matter, and what the president is doing, if you have concerns about that, that's why you should want legislation, so it can be brought within the regulatory perimeter.
I also wanted to ask a little bit about eToro, since they have their IPO coming up. What does it mean that you have a group that's kind of merging crypto with a little bit more of traditional financial investing? And what does it mean for the crypto industry as they get closer to being adopted a bit by this mainstream financial markets and regulations?
Yeah, well, we see crypto as a technology to update the financial system, and that means everybody is going to have to add crypto technology. It's kind of like when the internet first came around, and first you had .com companies, but eventually every company was using the internet. So we're really supportive, and we see that every bank, every fintech, every traditional brokerage, they're going to start adding crypto products, integrating stablecoin payment rails. And Coinbase, we're the leader in this space. We can also help power that for a lot of these people when they come in. And so we're very supportive. We want to sell them our products and services. We want everyone to come into crypto.
Are you worried, though, that that could lead to more regulation on the crypto industry, and kind of the deregulation is part of the reason folks are interested in crypto to begin with?
No, actually, we think legislation is a big business enabler. That's why we're so supportive of it. In the past, we had a lot of lack of clarity, and it was weaponized against the industry. So we're supportive of getting both the stablecoin bill passed and market structure, which we think would allow the U.S. to be a financial and technology hub for many decades to come.
And, of course, big news for you guys on the S&P 500. Is that going to change your outlook at all, or the impact that Coinbase has?
Well, we're very happy to be included in the S&P 500. It now means that crypto is here to stay. It's going to be a part of everybody's 401k. It's a testament to the hard work of our employees and our investors, and it's a big appreciation to our customers, too, that helped us get to be one of the most trusted companies in America, and so we couldn't be happier.
Well, as we mentioned, Coinbase stock has surged nearly 50% in just the past month. Bitcoin is up, but only 22% of that time. Bitcoin's done well, hovering around 103,000 per coin. AI startup Databricks announcing a $1 billion deal to buy cloud-based database company Neon. Deirdre Bosa has more in Tech Check.
In the private markets, the AI trade, it never really went anywhere. And now Silicon Valley darling Databricks, it is once again flexing with another $1 billion acquisition. This is its third in just a few years, and really a signal that it's not just building a product, but consolidating an entire platform. I spoke exclusively to Databricks co-founder and CEO Ali Ghodsi this morning. He said that the pace of their M&A is not going to slow down, and he argued that it's easier to move while still being a private company.
I actually think that as a private company, maybe we can take more long-term decisions and think through, does this acquisition make sense for our long-term strategy? I've seen my peers in public company, they're sort of so obsessed with what's happening with the stock price every day. We don't have to worry about that. So I think this is perfect for us. And I should say also, everybody sees the upside in the Databricks stock. All the investors, all the Neon team, everybody sort of wanted stock in Databricks. They didn't want to have cash.
They wanted equity, not cash, kind of telling you how popular Databricks is in the private markets. But, the startup's buying spree, it also raises the competition for public AI companies that competes with like Snowflake and Palantir that haven't been quite as aggressive on the acquisition front. I also asked Ghodsi about the massive AI deals coming out of the Middle East this week and whether that could be the next catalyst for the trade at large.
Many countries will invest heavily to say, well, it's our model, that we trained at our, country, and it's really sort of, it represents our values really well. So I think there's going to be an arms race for open source. And if governments are involved investing in this, then, I think that the United States should do that as well. So I think we're going to see that happening across the board in many, many places.
So sovereign AI, guys, no longer just a policy debate anymore. It's becoming a global market force that was certainly on display this week in the Middle East. And so for companies like Databricks and others, both public and private, that means more demand, more infrastructure, and possibly more deals to come. Finally, guys, on that public versus private debate, which Ali is always so great on. He didn't seem eager to IPO, but we are seeing a bit of a thaw in the IPO market and non-AI names like eToro today, and of course the Chime filing that came out yesterday. Just maybe don't hope for Databricks anytime too soon.
I was just thinking, Dee, if the AI trade overall kind of survived the April tariff drama, I mean, if things resolve there or at least steady, and you do get some capital markets activity, it makes sense that the AI IPO or M&A move would catch some steam.
It's true. Maybe the M&A move more so because the money is so flush still in private markets, as we've seen from these massive deals from Databricks, OpenAI, potentially another one from Perplexity, giving them, little reason to actually go public if they can build in private, like Ali says. The next catalyst, though, I talked to him a little bit about DeepSeek. We're expecting, the next model release, R2 from DeepSeek, and there's a lot of speculation on what that could do to the trade. And, he sort of heard similar speculation, says this could be another catalyst and really, heat up the race once again for open source and rattle some things over here, potentially.
Final check on markets and your money next. And thank you all for watching U.S. Markets Edition. I am Brian Sullivan. Squawk Box Asia is up next.